You might not need to sell your crypto, even when you need cash. Because there's a strategy the wealthy use to unlock money without losing their assets.
All right, so if you're a long-term crypto holder, you've probably got some assets just sitting there, right? Kind of collecting what you might call digital dust. You believe in the future, so selling is the absolute last thing you want to do. But what happens when you need cash? Today, we're going to dive into a really powerful strategy to unlock some of that value from your crypto without ever hitting that sell button. I mean, this is the classic dilemma, isn't it? Life happens. You might need cash for an emergency, a big opportunity pops up, or hey, maybe you just gotta pay the bills. Your crypto portfolio is sitting there, it's valuable, but it feels locked away. And you're stuck with this tough choice. Do you sell a piece of your future, or is there another way? For most of us, the immediate reaction is to just sell a little bit. It feels like the simplest, most direct solution. And, sometimes it is the only option. But this obvious move, it comes with two pretty significant hidden costs that can seriously impact your wealth down the road. Okay, here's the first big one, and it's immediate. The very second you sell your crypto for a profit, boom, you've created a taxable event. That gain isn't all yours anymore. A slice of it now belongs to the government. It's an unavoidable consequence of selling that directly cuts into the cash that actually ends up in your pocket. So how much are we really talking about? Well, if you've held your crypto for over a year, you're likely going to pay the long-term capital gains tax rate. Now, this changes based on your income, but for a lot of people, that's 15 to 20% of your profit. Gone, straight to the tax man. That's a hefty price to pay just for some liquidity. But believe it or not, it gets worse. Now for the second hidden cost, and honestly, this one can be even more painful: opportunity cost. Just imagine you sold some Bitcoin when the price was at $30,000 to get $10,000 in cash. A couple months later, the price doubles to $60,000. Yikes. Not only did you pay taxes on that sale, but you completely missed out on all that future growth. The part you sold is gone, and trying to buy back in now costs you twice as much. So what's the alternative? Well, let's take a page from how the wealthy handle their assets in other markets, like real estate. They don't sell a wing of their house every time they need some cash. No way. Instead, they borrow against the value of their property. They get the liquidity they need while keeping their valuable, appreciating asset. And guess what? The exact same principle can now be applied to your digital assets. This strategy is called a collateralized loan. And the mechanics are actually pretty simple. You pledge your crypto as a collateral, and a lender gives you a cash loan. Here's the crucial difference, though. You never sell your original crypto. You still own it. You're still exposed to all of its potential upside. You get the cash you need right now, but your investment keeps on working for you in the background. This table just makes the math crystal clear. Take a look at the top row for selling. You lose your Bitcoin, you trigger a tax event, and you give up all future gains. In our example, that's a potential $5,000 in lost upside on top of your tax bill. Now, look at the second row for borrowing. You keep your Bitcoin, there's no taxable event, and you capture all of that future upside. Your only cost? The loan interest, which is around $1,290 a year in this scenario. When you put those numbers side by side, the advantage becomes pretty obvious. Now, before you run off to do this is probably the most important part of this entire explainer. This strategy is powerful, for sure, but it is not risk-free. There are two major risks you absolutely have to understand and respect before you even think about borrowing against your crypto. So let's break them down. The first, and frankly the biggest risk, is captured perfectly by this old crypto mantra. When you borrow against your crypto, you are almost always transferring it to a third-party platform. And that changes everything about who's in control. Let's be very, very clear about what this means. You are sending your crypto to someone else's wallet. You no longer hold the private keys, which means you are trusting that company completely. You're trusting their security to stop hackers, you're trusting their financial health, and you're trusting them to follow the rules. This is called counterparty risk. And as we all saw back in 2022 with platforms like Celsius and BlockFi, if that counterparty fails, your assets can be gone forever. The second risk is more mechanical. It's called liquidation risk, and it all comes down to managing your loan-to-value ratio, or LTV. This ratio is pretty simple. It's just your loan amount divided by the value of your collateral. And in a crazy volatile market like crypto, this number can change fast. This slide does a brilliant job of showing you the key to borrowing safely. Just look at the example. With $50,000 in collateral, borrowing just $10,000 gives you a very conservative 20% loan to value, or LTV. This creates a massive safety cushion. Even if the price of your crypto takes a nosedive, your LTV will likely stay in a safe zone, protecting you from a forced liquidation. A liquidation is where the platform automatically sells your collateral to pay back the loan. The people who get hurt are the ones who get greedy and borrow the maximum amount they can. So the crucial point is this: if you choose to use this strategy, you have to be intentional and you have to be cautious. Treat self-custody as your default setting, your home base. See these platforms as specialized tools, not a new bank account for your whole stack. Only move the collateral you absolutely need, borrow with a low LTV to give yourself that buffer, and most importantly, fully understand these risks before you act. Ultimately, this whole thing comes down to a shift in perspective. Are your digital assets just something you buy and hold, hoping the price goes up? Or can they be an active, dynamic part of your financial life, a tool you can use to get liquidity, manage your taxes, and build wealth, all without having to sell your long-term positions? The choice and the responsibility is all yours.
So the biggest cost isn't taxes, it's losing future growth. Subscribe to learn smarter ways to use your assets.